I should buy some gold.
So often I see some confusion as to the exact role that gold has to play in our financial systems, and I see this in beginner investors a lot. And I don't really blame you guys for it because it seems like every time you turn on the TV, you get swarmed with ads that says, buy gold now, invest in gold, we trade cash for gold, things like that, right? You guys have seen those ads, I don't have to elaborate on that any further. But I think what a lot of beginners investors don't understand is the exact difference between what is an investment and what is a hedge. Now, it depends on exactly how you define investment, but for me, the way that I define investment, gold is not an investment. And you cannot invest in gold. Well, what do I mean by this? Well, think of it this way. If you buy a farm, you know exactly how much the farm is going to produce in a year. Let's say you buy a farm and let's say you grow soybeans, right? So you're growing soybeans and you know how much soybeans you're going to grow in that year, roughly. And you know the rough price of the soybeans that you're going to sell. Now, it might fluctuate a bit, but even if worst case scenario, let's say the worst case scenario happens and the demand for soybeans falls through the floor, and you're just sitting on a bunch of soybeans that you can't sell, well, you can probably find some way to preserve them and maybe just eat them yourself. So soybeans have what's called intrinsic value, meaning that even if the worst case happens, there's some value locked away in those soybeans. Now, I would say that gold does not have intrinsic value because you can't eat it, it just sits there. Now, why do I bring up buying a farm? Well, buying a farm is kind of like you're buying stocks, right? Because you got to remember what stocks are. So stocks are parts of a business. And let's say you buy stocks in, let's say, a company that owns a series of farms, then you're a part owner of that farm, right? It doesn't have to be farms. I'm just raising this as an example. It could be anything, right? Let's say you buy Apple stocks, then you're a part of Apple. And whenever they sell an iPhone, you're entitled to probably a very small fraction of that profit that comes with every iPhone sale, right? Because you're a shareholder. So if you would notice a common theme between, let's say, running a farm or buying a stock and things like that, is that they all offer cash flow. So cash flow is really what defines an investment versus what's not an investment. So for example, back to the farm, if you're running a farm, then when you sell soybeans or when you sell whatever products that you produce on the farm, you get money out of it, right? So it puts money into your pocket. Now, same thing with a stock. When you buy a stock, sometimes you would get paid out dividends, right? So dividends are a form of cash flow. But some of you might say, but hey, some stocks don't pay dividends, right? Well, true, but even if they don't pay dividends, they still earn money. And then when they earn money, they keep it on their balance sheet or they keep it in cash or they reinvest it back in the business. So they still cash flow at the end of the day. It's just that if they don't pay dividends, you don't necessarily get to really control it or see it as a shareholder, but it's still part of the company's balance sheet. Now, a prime example of a stock that has a lot of cash flow that I talked about recently is Berkshire Hathaway. So Berkshire Hathaway, they don't pay dividends, but they keep 130 something billion dollars on their balance sheet. So they have a lot of cash stored away. So some other examples of things that I would classify as investments is, for example, real estate. So real estate is another example that cash flows, right? So for example, if you buy a house and you rent it out, then you would put money into your pocket by your tenants paying you their rent. So by this definition, gold is not an investment because gold, it just sits there and it doesn't generate any productivity, right? It doesn't generate a service. It doesn't generate a good. So gold is only worth as much as someone else is willing to pay for it, which makes gold not an investment because it does not cash flow. It just kind of sits there and looks pretty and doesn't contribute anything positive to your life, kind of like your ex-girlfriend. Now I'm going to put up a chart of gold price versus the S&P 500 versus the Dow Jones and versus silver. And from first glance, it does look like gold is outperforming the S&P 500 and the Dow Jones. But what you got to keep in mind is, remember what I said about the cash flow. So because gold does not cash flow, there's no dividends that it throws off. So you cannot reinvest dividends because there are no dividends. Versus with stocks, let's say an S&P 500 or the Dow Jones, if you buy stocks in those indexes, some of them will pay dividends and then you can reinvest those dividends. And when you reinvest those dividends, you can see that giant black line on the top there. And that's with all your dividends reinvested. And as you can see, if you do reinvest all your dividends and doesn't just depend on the spot price of your stock increasing, then you can see that as a whole, the stock market has outperformed gold by a pretty long shot. Now, I know what you're gonna say, you've just spent the first however many minutes of this video trash talking gold, and now you're saying that you're buying gold? What the heck? Well, I'm buying gold because of the second reason, which is to use it as a hedge. No, not that type of hedge, a financial hedge. So a financial hedge is an asset that reduces the risk of depreciating values of another asset. Now, I know that sounds like a mouthful, but to put it simply, a hedge is simply something that you hold to protect yourself in case something else that you hold goes down in value. So in this case, gold is a hedge against currency, namely US dollars, Canadian dollars, just any type of fiat currency that we have. Now, fiat currency just means paper money, by the way, so money that the government prints and the government just goes, this piece of paper has money, you should use this as money. So the value of fiat currency is wholly dependent on the government that issues it, and not because it has any sort of intrinsic value, kind of like soybeans or whatever. Now, gold is a hedge against fiat currencies because gold is traditionally seen as something that's valuable. So gold's been valuable ever since ancient times, right? If you go back to like ancient China or ancient Rome or Egypt or wherever you go, you can see that people trade gold as currency before fiat currency was even invented. And now, to illustrate why gold is a hedge, you don't need to look that far back. You can just look at, let's say, a country like Venezuela. So the Venezuelan government would like you to believe that $1 is worth approximately 10 Venezuelan bolivars. Now, this is very untrue because if you actually look at what's going on in the ground in Venezuela, a chicken which costs about $2 US is worth about 14 million Venezuelan bolivars. So if you're doing the math at home, the actual price of $1 is probably somewhere around 7 million or over 7 million Venezuelan bolivars. Now, this made news a while back because Venezuelan bolivars are now so worthless that it's actually worth less than World of Warcraft gold. Now, if we move on to another case study like Zimbabwe, for example, if you would remember this is the $100 trillion bill that the Venezuelan government printed in 2008 in order to be able to pay off all its debts. Now, there's a problem when governments just print money, right? So when they print money and they increase the money supply, it doesn't make everyone rich. Well, it makes everyone trillionaires, but being a trillionaire basically means nothing because your money is actually worthless. So if you wanted to be a trillionaire, all you had to do is move to Zimbabwe in 2008, and one of these bills probably costs less than $5 US, and you can be a trillionaire as well. You can be 100 trillionaire, not just the regular trillionaire. But of course, all these bills are worthless. Now, I shouldn't say that they're actually worthless because they're actually collectible on eBay these days as a novelty item. So they actually sell for quite a bit on eBay. But aside from that, that's just because people want to collect them. But if you wanted to use it as an actual currency, it wouldn't work. So this phenomenon is called hyperinflation. And hyperinflation happens when the price of goods balloons to such an extent where your money essentially becomes worthless. So imagine that you're going to buy a loaf of bread at the store and it costs, let's say, $3 today. And then you go back to the store tomorrow and it costs $10. And you go back tomorrow and it costs $100. And then the next day it costs, let's say, $1 million. So hyperinflation just basically takes off and it just destroys the value of your money. Now, if you were a Venezuelan citizen or a Zimbabwe citizen when the hyperinflation was going on and you had all your money in gold instead of in bolivars or in Zimbabwe dollars, then you would be golden, right? So you would be all set. Because the value of gold doesn't inflate that much because there's only a limited amount of gold out there in the world. So the government of the world, they can print as much money as they want, but they can't print gold because the amount of gold in the world is fixed. I mean, sure, there's some gold that's probably still locked away in the earth and not accessible, and you can mine it out if the demand is high enough. But overall, the amount of gold on Earth is fixed. And because of that fact, the price of gold is unlikely to crash to, absolute zero unless we get hit by an asteroid full of gold. And if that happens, it's probably not the biggest concern that your money is worthless. You have to deal with an asteroid hitting Earth. Now, I'm talking about hedging and hyperinflation and stuff like this because, as you know, of this crisis that's going on, the governments of the US and Canada and parts of Europe are doing this thing called quantitative easing, or QE for short. Now, I'm not going to explain QE because it's kind of complicated and it's out of the scope of this video. But essentially, what QE means is that the government is printing money and increasing money supply. Now, this is a concern because if the government prints too much money, then it could cause hyperinflation. Now, do I think that the US and Canada will turn into the next Venezuela and Zimbabwe? No, I don't think so. But I think that it's always smart to take some steps to protect yourself against some inflation, which if the government continues to print money, then inflation might be a problem further down the line as people start spending more money. So yeah, essentially that's why I'm buying gold. And keep in mind, this is only a small part of my portfolio. So I'm only allocating about 5% of my portfolio to buying gold. So don't think of this as, oh, I'm just selling all my stocks and putting everything in gold, or let me put my tinfoil hat on, the government is corrupt, or something like that. No, I don't think that the hyperinflation is going to necessarily happen in the US and Canada. But I do think that maybe keeping a small percentage of your portfolio locked away in gold could be a great way to hedge against currency inflation. Now, as for specific ways one can invest in gold, I suggest the ETF GLD. So GLD is what's called the SPDR gold shares, and how it works is that essentially they have a vault in, I think, London, they said, where they keep a bunch of real physical gold. So you can buy shares of this gold as if it's a stock or something like that, but it's actually tied to actual gold that's locked away in a vault. Now, the advantage of buying GLD as opposed to going out and physically buying gold yourself is that you don't have to actually physically store it, right? So you don't have to stash it away in your house, and if you stash it away in your house, then you can have your house broken into, have your gold stolen. So I think that GLD is a great way to minimize the cost of storing gold. Now, there is a management expense ratio, so they do charge a small fee for holding the gold on your behalf, but it's very small, like 0.4% or something like that. And I think that that price is more than reasonable considering the service that's providing, which is storing gold on your behalf. And now another advantage is that this is more liquid than having physical gold. So imagine that if you're holding gold bars at your house and then you have to go out and exchange it, and you have to find a merchant to buy it off of you, and you might have to pay a lot more than spot price when you bought the gold, and when you sell it you might have to sell it at a price that's not what you wanted, right? So I think that having gold shares, having GLD in your portfolio as opposed to actually holding gold is a better way, because these shares trade just like stocks because it's an ETF, and it's just a lot more liquid than comparing to actually holding gold itself. So yeah, there's no gold at my house. Don't break into my house, guys. Anyways, I just took GLD as an example. You guys don't have to buy GLD. There's many options for you to buy gold ETFs and things like that. So there's ones that are Canadian dollar hedge too, for those of you that are in Canada. So for those of you that don't know what Canadian dollar hedge means, basically that means that the performance of the portfolio is actually pegged to the actual gold itself. So it's not pegged to the movement of Canadian dollars. So let's say if Canadian dollars crash and Canadian dollars are worth a lot less now, and we're calling them Canadian rupees, well, your Canadian dollar hedged gold portfolio will still perform relatively the same as to the regular actual gold price. So I think that that offers you an extra layer of protection against currency movements. It all depends on your risk tolerance. If you want something really safe, then maybe you want to double hedge, right? So you want to hedge against the Canadian dollar with a gold portfolio, and you want to hedge against currency fluctuations of the Canadian dollar with that gold portfolio. So you can buy a Canadian dollar gold hedged fund. Now, I don't want to go through all the options because I don't want this video to be like 5 hours and there's way too many of them. But yeah, essentially, that's why I'm buying gold. And again, I'm only keeping a small percentage of my portfolio in gold. So don't think that this is such a large proportion of my portfolio, or don't think that I'm some type of like doomsday prepper or something like that. I'm just doing it sort of as a hedge against the currency. But anyways, I'll leave the video here. Be sure to hit the like button if you enjoyed the video, and consider subscribing if you like this series. Be sure to follow me on Twitter and Instagram. I'll leave the links down below in the description as always. And with that being said, I'll see you guys in the next video. Bye-bye.